Welcome to Friday's Financial Fitness. Today I would like to take a little bit of time and explain the potential risk of owning Treasury securities. U.S. Treasury securities are backed by the full faith and credit of the U.S. government. Obviously, there is very little risk in the Treasury Department's ability to pay its own government bonds back. However, there is another type of risk that I want to make you aware of, and that is a risk we call interest rate risk. This risk isn't only applicable to Treasury securities, but I want to use Treasuries as an example so you can understand how interest rate risk applies to other bonds. According to BTN Research, on July 8th of 2016, the 10-year Treasury had a coupon of 1.625%, and the price of that 10-year Treasury was at 102.36, ultimately giving it a yield of 1.36% for that 10-year Treasury. The rate of 1.36% is the lowest the 10-year Treasury yield has ever been. If we fast forward to the current April 25th 10-year Treasury, if we look at that same Treasury that was purchased back on March 8th of 2016, it still pays the same 1.625% because they don't change the coupon rates. But that Treasury today, a year and a half later, is actually priced at 90.13, giving it a yield of 3.03%. It may not seem like a big difference going from 1.36% to 3.03%, but if you notice in the price, we've gone from a price of 102.36 all the way down to 90.13, which is a drop of 12.23 points, which translates into a drop of almost 12%. In other words, if you had invested $100,000 back in July of 2016, that $100,000 would have dropped the principal value by 12%. Certainly, if you hold the bond until maturity, you'll get all of your original principal and interest. But if the bond was sold prior to maturity, certainly there is interest rate risk.